can't change the grade.
The first thing we're going to discuss has to do with, of course, the logic behind the fair value gaps, the logic, facts, and some tips. So the 3-bar pattern known as the fair value gap basically is showing an inefficiency in price delivery for one side of the market versus another, right? Like this. So this is the sell side, and there's an imbalance of buy side, meaning there's, it needs to, for price to be efficient, it has to trade back up into that area of inefficiency to offer the other side to the market, right? So in a nutshell, that's pretty much the significance, right? And that's why price likes to seek them, right? And if you think about this too, just a little extra perspective, if you think about why does price retrace? Well, it's seeking some form of a PD array, because most of the PD arrays have to do with fair value in the market, and retracements, like for this bearish price delivery, retracements are pretty much to not only allow the other side an opportunity, but it's also to position smart money's sells in more of a premium price level. Or if we're retracing here in the bullish move, it's trying to pull us down to some form of a lower price, buy low, sell high, right? So fair value gaps have different variations visually, but the pattern dynamics are going to be the same. So don't get too caught up in, oh, this one's smaller than the other, or oh, this one's really big, so on and so forth. The dynamics we're going to discuss today are pretty much basically, just the way things work, right? From my experience using fair value gaps, high probability fair value gaps occur in the direction of the higher time frame. So for example, bullish fair value gaps are favored in bullish moves. Bearish fair value gaps are favored in bearish moves. A tactic I like to use a lot is to look for high probability fair value gaps using the model 13 or the 2022 model that ICT's taught. Basically, if we're bullish, a run on sell side liquidity is a good sign. If a rejection takes place higher, to then start seeking bullish fair value gaps. So pretty much in a nutshell, the YouTube model helps you identify, a lot of different things, and, helping you identify, the high probability fair value gaps is one of those specific things that it's beneficial for. And then of course you could pair things with order blocks and, different things, which we'll discuss a little bit later. And basically, if we are bearish, a run on buy side liquidity is a good sign. If a rejection takes place, to then start seeking bearish fair value gaps. And of course, something that a lot of people overlook is the fact that fair value gaps can act as draws on liquidity on the higher time frame. And the idea is fractal, right? So the way that you observe the higher time frame daily chart is the way you would observe the lower time frame chart as well, right? The dynamics of your analysis. It's very important to keep track of the higher time frame perspectives. And what I mean by it can act as a draw on liquidity is pretty much what I was kind of touching on a second ago. How if this is, price is going lower, it's not uncommon for price to want to reach back up into that fair value gap because it wants to offer the other side of the market, and it's inefficient. And the market has to be efficient, right? And offer both sides. Not only that, like I said, it also, if it's a bearish market, it's offering smart money more premium price levels. Say this here was the daily chart, and this is Sunday's close down here. It's not uncommon for Monday and Tuesday to try to push price higher to seek a premium price level. And then if you think of like Power 3, for example, Monday, Tuesday generally creates manipulation, or, Sunday, Monday generally presents manipulation. So Sunday, Monday could be 2 bullish candles going higher. And then Tuesday could, present the high inside the fair value gap and then fall. So if you haven't watched my Power 3 bootcamp series, it's definitely recommended that you do so. I'll leave that in the pinned message above. But yeah, moving forward, fair value gaps don't always fill all the time, but then again, they also do fill sometimes, and they can stay valid throughout price delivery. So like they can be reutilized or reclaimed later, and well in the future they could be used as well. The price delivery to the right over here, that's showing price being fully traded to and utilized, and then once price trades away from it, away from the fair value gap, it's not generally expected that it will come back if we are in a heavily bearish market or a heavily bullish market, right? So just some things to consider. Fair value gaps get reutilized at times and can also turn into inversion levels, which we'll discuss in a little bit. That's basically the idea, like the real idea of support turn resistance, or vice versa, resistance to support. When traded through, for example, in a bearish fair value gap, that bearish fair value gap can turn into a bullish inversion fair value gap. And the opposite is true for a bullish fair value gap that's disrespected and traded through as well. But then the higher time frame fair value gaps and the relative levels are impactful from the higher time frame all the way down to the lower time frames. So it's very important to have, like, if this was the daily chart, it's very important to have like this level, and the midpoint outlined. So when you're on like the 15 or the 1 minute, you can see the level that was utilized from the daily chart, because being able to do that will show you high reaction levels when you're on those lower time frames. And especially if your model forms inside the kill zones or inside the kill zone that you utilize, if your model shows around one of these levels, it could generally lead to a quick move. Right? So just some things to consider. They can also be broken down into quarters. As you see, I have the 50% level marked. Generally, when we see like a bearish trend and we're looking for a bearish fair value gap to hold in price, a signature that shows we're heavily bearish, for example, would basically respect the 50% level or below. So the 25 and the 50%. And it's even better if it does not hit the 50% level, right? So, and if it doesn't hit the 50% level on a bullish fair value gap either, that's also showing we're heavily bullish. And that's what we would like to see. That's also classified as institutional order flow entry drill in many cases. But yeah, so breaking them down into quarters is also something that you can utilize on the lower time frames too, as prices delivering. Say this was the 1 minute, right? This right here would be a signature showcasing, especially if we have a lower liquidity pool, it could be showcasing that we're heavily bearish. Okay, or of course, we could be heavily bullish if it does that similar thing, just in a bullish capacity. So the realities of choosing the correct fair value gap. You'll never really know what fair value gap will 100% of the time be attacked and how it's going to respond in that fair value gap, just like many things in the market. So don't listen to any idiot who tells you otherwise, because you can never be 100%. It just doesn't exist. No 100% perspective exists in the marketplace in general, right? So keep that in mind. But there are ways to make things more high probability, right? And layer confluences on top of things so you can develop further trust. Inside higher time frame fair value gaps, when you go lower in time frame, you'll see multiple lower time frame fair value gaps. Something you want to consider with that has to do with premium and discount levels. For example, when you're looking for a bearish fair value gap, ideally you want to aim for the ones that are at a premium price level in the current range that you're trading in. That's pretty much the logic of sell high, right? And then keep in mind, sometimes if price is heavily one-sided in a bearish market, it may use the closest fair value gap and run. And if you have watched ICT's Model 13 or 2022 model, those are the same. He pretty much shows and talks about how it doesn't always reach the highest fair value gap and a highest premium for a bearish move, or it doesn't reach for the lowest fair value gap in a discount for a bullish move. Sometimes if it's super quick moving market, it will react to one of the first ones that it hits. But again, that doesn't mean that it won't come back to it, to the other ones, because remember, things can be reclaimed or retraded too, depending on what's happening currently in the market. When looking for bullish fair value gaps, you want to consider the ones that are in a discount price level, which basically means, justifies the buy low, right? Sell high, buy low. That's what people say all the time, but this is like why that's even relevant, right? Keep in mind, sometimes if price is heavily one-sided in a bullish market, it may use the closest fair value gap and run. Like I said about the bearish scenario, just flipped around to bullishness. When seeking the ICT PD arrays in general, again, you want to keep this premium and discount of a range in mind at all times, because you want to buy low, sell high, right? Like that's what we're trying to do to maximize things. And then when price trades back to a fair value gap that's been created and then trades away from it, as you see here, this is a fully utilized fair value gap or an area in price that's made efficient. And if the trend is to continue, we would like to see it continue to be respected. Basically saying, if price comes up into this and then trades away from it, right? If it offers trading inside the fair value gap and then trades away from it, that's generally showing that prices already used that fair value gap. But again, it can be reclaimed. Not every fair value gap will be reclaimed quickly. Sometimes it takes weeks, months, days, right? So you just got to work with the information that you see and know a good understanding of the dynamics behind bias, right? And why price is doing what it's doing and why it should do what it's doing, right? And then similar thing is happening here. Price traded. This one actually filled the whole fair value gap. Remember, they don't always have to fill. This ideally is what you want to see if price is moving one-sided bearish, or if you flip it around, if it does this and only hits the 50% or the 25% and then rallies. That's what we want to potentially see, right? For us to have faith in the fact that it's actually quickly going to run, and we're in a fast trending market. Generally, this happens in a trending market, this type of characteristic. One thing you also want to consider has to do with why this occurs, with the 50% being respected or not filling a fair value gap fully. Well, sometimes there is like a breaker over here. There could be a breaker here, and then this midpoint or close to it could be like the low of the breaker, right? So price wouldn't have to necessarily come back and fill this little area, right? Especially if, you know, just took buy stops, shifted market structure, created a breaker, and now price retraced back into it. Or this could be an order block here, right? The low of the order block could be right here at the 50% or right here at this lower portion, and then you pair the order block and the fair value gap together. That's that's one of those reasons why price doesn't have to fill or fully deliver the fair value gap. All right, so I hope that made sense. If you guys have any questions, let me know in the comments. And if you haven't subscribed already to the channel, but you've been getting value, I definitely appreciate it if you like, comment, and subscribe. It really helps the channel out. And, you know, we're all friends here, right? So moving along. Let's look at some examples. So we could see how, like I just said about the order block and the breaker potentially making it so a fair value gap doesn't fully fill. Well, we could see that price ran the highs here, price shifted market structure or broke market structure, and then price retraced, leaving this upper fair value gap open. So of course, if you go from high to low, the equilibrium point is right in the middle, right? Or premium price is in the middle of this, right? So price barely touched into the premium price level, but then you could see the reaction coming off of it. And why did this one not get tapped into? Because there's already PD arrays that are below that fair value gap. So it doesn't have to go up there. It could, but it doesn't have to. And you can see these two consecutive up candles. What is that? That is an order block. So that order block held price as it pushed away. There's also a breaker in that little area as well. So multiple things were layered to make it so it didn't have to come up there. You can also see this little fair value gap. I didn't mark that, but drag that out. That's also another level of inversion, also up here. So multiple things layered on top of the shift in market structure after buy side liquidity was taken have basically promoted the fact that it doesn't have to go all the way up there. And you could see sometimes if it's a quick market, as you see, it's not going to have to fill or go to a premium in this bearish move, right? It just purged, the previous day's high, and then now it attacked the lows, right? And just kept pumping and pumping and pumping. Right, so then you can also see now for bullishness, if you go from low to high, this is equilibrium down in here. Okay, so it pulled back to a discount. So prices were tracing inside the range to a discount to go higher, right? And then again, another example, if we go from this low to this high, we could see how price dug lower into this discount area, and then it spent a couple weeks in this, right? These little gray lines that you see on the chart, those are highlighting Sundays. So we could see how prices seeked discount fair value gaps to rally for the retracements, and seeked premiums, or at least above the 50%, which is a premium, to then look to sell. Fair value gaps don't always have to get attacked and can act as breakaway gaps like this one when there's other PD arrays in alignment. Right, and you could see here as well, right? You go from low to high, you could see how price dug lower into this. So because buy side was taken, sell side was taken, and then price got above this, right? We wouldn't expect this here to dig extremely deeply into this, because this is a balanced price range. Okay, so for more unbalanced price ranges, you can look at my market maker buy model or market maker model video, because I touch on that as well. So I'll leave that also pinned here for you to go enjoy, either before you finish this one or after. So yeah, and you could see how this fair value gap from this low to that high, price dug down to a discount, also hit an order block. So it's a high probability fair value gap and an order block. Then it rallied, consecutive down candles here, that's an order block, buy side taken, sell side taken, balanced price range. So it doesn't have to come deeper into that. And of course the 50% level would be something that we'd want to observe in an order block. But we'll talk about order blocks on another day. But yeah, you could just see how from low to high, price dug lower, hit that, and rallied. Right, it's continuously doing, going from premium to discount, and then from discount to premium for sells, and then discount to premium for buys. So I hope that makes sense. Highly recommended that you go and do these things yourself as well. Pull out as many examples as you can, and I'm hoping that this lesson here will help you have a more objective way to go and study, more actionable, objective things to look at when it comes to fair value gaps. So one thing I wanted to kind of drive home is the fact that price seeks specific PD arrays in the PD array matrix, and then it seeks specific PD arrays in a specific order. And it's, bullishness is looking for discount PD arrays, which would be these here. And I don't know why this is by situations. This is supposed to be sell. My bad, there's a little typo. But if you're looking for buys, price wants to retrace and reach down to a discount, which is below the 50%. You could see how price would seek one of these PD arrays in this order. So if there's no mitigation block, you look for a breaker. If there's no breaker, you look for a liquidity void. If there's no liquidity void, you look for a fair value gap, so on and so forth. And you work with what you have in price, right? And if price was right here, or we just came off of this high, we would look for some form of a discount to buy from, because you want to buy low and sell high. Where do you look to buy low and sell high? Well, you have this specific order in which the algorithm seeks PD arrays, points of interest, to then go on about its business. So then you take this and you bring that over to here. So if price was in this bearish situation, price retraced higher, what's the first thing? Mitigation block. Well, if there's no mitigation block, what's the next thing? A breaker. Well, there is a breaker there, right? So price didn't have to go all the way up to this fair value gap. And there's also this order block. So there's multiple things layered on top of itself in that area, promoting the fact that this doesn't have to come back to this fair value gap, and it would act as a breakaway gap. So keep in mind that this perspective is utilized also on the lower time frames. So when you're getting into an entry, you want to consider this specific idea, right? And then all the things we've already discussed about fair value gaps. So again, if you have questions, please leave them in the comments. I really want to get y'all to be super clear on these things, because something like this idea here is very, very important, along with all the little things that we're discussing about fair value gaps, right? So again, just break down the previous example over here. We'll break that down further. We go from high to low. Like I said, price came back to the equilibrium point. You could also see the wick here was also respected, but nonetheless, you could see the consecutive up candles. You can see this down candles range, drag that out. It's also been respected, and then price continued to drop. So, and then if you come to here for the bullish idea, right, from low to high, price didn't necessarily get deep enough into the range to be at a discount, but you have this fair value gap here as well. Again, it doesn't always have to come down to a discount, or it doesn't have to always come up to a premium. We want to see that ideally, because think about it like this. You can buy a product at sticker price, right? Say it's like $50, or you can choose to wait and try to get it on sale. You can do both, but which one would you rather do? You'd rather buy it at a discount or on sale or whatever. Well, when price is digging into a discount for a bullish scenario, that's like a sale. And if price is rallying up in a bearish market and it gets up to a premium, you're basically selling it at a higher price. So it's like an inflated price. So that's the perspective you want to have about premium and discount, and why that's important, like where that even fits in everything. It's basically like, regular buying and selling something, right? It's the same idea, and many people overcomplicate it, but, don't be one of those people, right? You want to frame out your range and then be able to identify where premium prices are and where discount levels are, and then find the fair value gap, order block, or, PD array that's in alignment with that and the higher time frame narrative and what the draw on liquidity is. Very important. So then we do this again, right? We go from low to high. We could see, yes, there's a fair value gap in here, and yes, it runs the risk of price taking off from there, but you could see how price dug lower. So if you took a loss in here, you don't start thinking, oh my God, I'm wrong, and start beating yourself up and changing your whole perspective. You just look for what's the next fair value gap or the next PD array. And you could see how price came down perfectly and tapped into that and then continued to rally. So then if you wanted to identify in this range, after sell side was taken, buy side was taken, this is a balanced price range. We don't anticipate it breaking through too deeply into the midpoint or equilibrium point. The quicker it reacts, the better. So, and then price dug lower here, and then price got right just below the 50%, filled in the rest of the fair value gap, and then continued to rally. And then again, you can see how this low and this high, you measure that out, price dug lower, and price got into this little volume imbalance, which we'll discuss a little bit later. But again, you run the risk of it running from there. So it's something you always want to consider. And again, you will never be perfect, right? You'll never have things narrowed down 100% of the time, right? There is ways to get close, but especially being new, it's not ideal to think about perfection, because you don't need that anyway to be successful. So moving along, we can see it again, the same idea, right? There's two fair value gaps, but the lower one is a discount. We could see how price dug lower into that discount, and then price rallied away from it, attacking the engineered buy side liquidity. And then once, we got above this high, ran the stops here, stops have been taken here. So this now becomes our new dealing range. So price found this little fair value gap, but it sliced through it, and then price ended up really tapping into this lower fair value gap, and then ended up rallying again. Let's move on to the fair value gap and SMT, or any other pair or asset that has correlated assets with it, and you are in a bearish environment. SMT can be observed in correlated assets using fair value gaps. For example, if you trade the indices and you are in a bearish environment, if they all have a bearish fair value gap that looks to be getting traded to, and one fails to meet the fair value gap in, say, the NQ, doesn't matter which one, if the S&P and the Dow run, and NQ begins to run, leaving that fair value gap untouched or untapped. This is a variation of SMT, basically taught by ICT. So what do I mean? So this fair value gap here, or the CIBI, right? If price trades into it on the S&P and the Dow, but it doesn't get reached into on the NQ, this is a form of SMT, right? It could be treated as such in terms of the correlation effect. And so an example of that is this here. So here's a low, here's another low, here's a fair value gap in the S&P, but price didn't reach down into it, but NQ did. So that is a form of SMT. It's a crack in correlation. And then of course you'd aim for the draw on liquidity that's above in price, right? So very simple. Definitely go into your charts and observe it in this way, right? You want to get your own examples, but keep this little tactic in mind, because it's very helpful along with everything else that we've discussed. So volume imbalances. So volume imbalances are small gaps in price at times that look like the ones highlighted here, right? Or if we go back, there's one right there too, right? You can see how price dug into it. So volume imbalances are pretty effective as well. Volume imbalances get used as targets and magnets in price, similar to fair value gaps and just PD arrays, but they have a unique flexibility to them. They can get traded through multiple times and still be valid. So price can do something like this, it could do something like this back and forth, or it can react quickly, but then it would still be a valid volume imbalance until we move away from it. If a full body candle closes overlapping the fair value gap, the use has now been exhausted, like in this second example. So price dug through it and then traded all the way through it to the buy side, right? Or if this one had just one bullish candle breaking all the way through it, it could be used as inversion resistance turned to support, right? Just some things to consider. And let's look at a couple examples. So volume imbalance here, price traded into it, traded outside of it a little bit, but again, they're pretty flexible, and then price ended up jumping away from it and going higher. We could see a volume imbalance here. This volume imbalance has pretty much been traded through multiple times, right? It overlapped it with a full body candle, closed through it and outside of it, and then price just returned back to it and used it as a rejection, and then it traded one more time into it, and then eventually ran away from it. And again, this volume imbalance here, there was a full body that closed below it, it closed through it, so it shouldn't have to come back to it. It's already been exhausted, just like it was over here. Traded through it, came back, tapped it one more time. There's consecutive up candles here, so that could be an order block. Drag that over and you could see how that's being respected as well. So again, we have that layered confluence effect. You go from low to high, given what we just discussed. Prices dug down, and that's below equilibrium as well. This is a new week opening gap. And then here's another volume imbalance example. Price left the volume imbalance, but price traded through back to it one more time, and then price rallied away. All right, then we look at the bearish example here. We could see how this was pretty much traded all the way through. It reached up for something in particular. When it does this, it could be reaching for an order block or a fair value gap or something of that nature. But then you could see how the closing basis of this candle and this candle basically stayed below it, didn't close through it. So that keeps this valid in terms of using it for the overall narrative, which in this case was bearish. You could see that signature. That's very important because the market's like a living, breathing organism, right? So it has certain things that the algorithm tips its hand to you. This type of scenario is one of those things, right? Where it didn't close at all through it, right? It's left the closing basis below it in a time where we could potentially anticipate price looking to sell off. Right, and then you can see the fair value gap here as well, showing heaviness, not even coming to the 50%. And you could see the result in the delivery. So we got another one here, right? We can see the volume imbalance, price traded a little bit through it, but you could see the closing basis stayed above it. It's an order block too, like the last down candle or whatever. And if you go from low to high, you can see that that's at a discount, right? So it's very important, like I said, to remember the PD array matrix and understand what range you're trading within. And if you guys have issues with that, just let me know in the comments and I will make a video about that as well, in terms of like navigating ranges, like dealing ranges and just ranges of opportunity, how to navigate from time frame to time frame. I'd be more than happy to dive into that as well. But yeah, so now let's talk about inversion fair value gaps. So inversion fair value gaps are basically fair value gaps that have been reused later, or have been basically traded through and then get reused in an inverted capacity. So in this case, this was a bearish fair value gap, but price ended up trading all the way through it on a closing basis, and the price returns back into it using it as support to go higher. So this is basically the inversion fair value gap. And if we like took sell side liquidity here and then price does this as well, and this is also a shift in market structure, sell side was taken, this inversion fair value gap would be significant and highly probable, especially if you see, say this was like a fair value gap in here, right? Like a bullish fair value gap. If you can layer an inversion fair value gap with a bullish fair value gap, in a scenario that looks like it could be bullish, maybe this here was an SMT. If you could layer these things together, you are pretty much a dynamo, right? You'll see that things happen a lot more than they don't. So yeah, so similar to, the whole idea is similar to support turning into resistance or vice versa. And when an inversion fair value gap, like I said, and a traditional fair value gap are layered in the same spot, you're looking to enter, that area generally is very, very responsive. And again, you want to go look in your own charts and pull out examples of this. So when a full body candle closes through the fair value gap, like shown here, we consider the fair value gap we are using as a possible inversion level. Like we discussed, right? Price traded through it, looked like it wanted to be used as a normal fair value gap to go lower, but things changed and price traded through it. Things started seeking buy side liquidity. Apparently ICT has more to teach on this in the future, which he's mentioned, but from what's been shown so far and what I've gathered from it, this is basically, what an inversion fair value gap is, and how it's generally looked and utilized in many cases. And of course, inversion fair value gaps are basically fair value gaps that have been reused, like I said. And so now if we look at the bearish example, it's got the same idea. Prices decided to reverse for whatever reason. Maybe there was an SMT, maybe it hit a daily order block, or whatever the case may be. And then price ended up, breaking through this low, and the price has this inversion fair value gap. And if you have another fair value gap like a bearish fair value gap here layered with this inversion fair value gap, that can help you with high probability selection when it comes to the inversion fair value gap idea. And remember, it's pretty much the same as resistance turning into support, or support in this case assumed support turning into resistance. So I hope that makes sense. So let's dig into some real chart examples. So like I said, if you can layer an inversion fair value gap after a run on stops, right, using the YouTube model or whatever model you're using, if it's related to using a fair value gap, if you can layer an inversion fair value gap with a real fair value gap, and that's in line with the higher time frame narrative, things can get real dynamic. Like we have this big fair value gap here that turned to an inversion, right? Price traded through it, showed little to no respect. And then we have another fair value gap here layered inside this fair value gap as well. And if you look over here, we have another one here as well. If you go to like the 4 hour, this would probably be a bigger one. You extend that over, you could see how it's been respected. Yes, it ended up turning, but mind you, you don't have to be perfect, right? You just have to be able to put things together and find an entry that day. If you're a day trader, we could also look here. We could see that this fair value gap here turned into an inversion as price traded through it. The midpoint of that inversion fair value gap was basically respected, and then price ran away. So again, another thing to remember, like I said about the regular fair value gaps, you can break down inversion fair value gaps into quarters as well with your fib. So just something you're going to want to go in and study a little bit further. We could see this also turn into an inversion fair value gap with price looking to go bullish, right? Price retraced, got into, in this case, it was a 2-day fair value gap. Inside that 2-day fair value gap, we had an SMT. Then there was a shift in market structure bullish in a bullish market. And then price, has an order block that was created with inside the inversion fair value gap. And then when this price came down and tapped into the order block and the inversion fair value gap and the new week opening gap, there's so many things in there promoting the fact that if, price wants to go higher, it should be dynamically occurring here, right? Because there's multiple layered confluences. right? So I hope that makes sense. And then this example here is something basically pairing everything that we've discussed together. We have an inversion fair value gap here that I forgot to mention. There's also one here. There's also one way over here. So once price showed its hand and basically took stops and then rallied up, price ended up utilizing the inversion fair value gaps. These consecutive down candles was an order block. And then of course we have the fair value gap here. So if you go from the low down here to the high, you see where the discount level is. Price reached all the way down into it. Yes, there's one here, but again, we wanted to buy low and then target buy side liquidity. And then if you take from this low to this high, or from this low to this high, right, you can get some extension levels. They're not guaranteed, but you could see how, the extension levels can help you out with anticipating how far it can go. But you could have just not used that and seen that there's a bunch of layered liquidity up here. The price ended up rallying to attack, as well as, there was equal highs or whatever. But again, you want to break down the fair value gaps. You look at their quarter levels, and you could start to see how they're utilized dynamically, and they give you more insights and clarity as far as what is occurring in price delivery. We could see this fair value gap here as well. Price held in this quick moving market. When there's a fast-paced market, generally it doesn't want to have to seek further discount. It could just utilize the first one that's in the vicinity. That's institutional order flow entry drew. And then price was so excited it didn't have any chance to retrace at all. Didn't allow any of these people that got taken out to the sell side to participate if they didn't participate somewhere in here. Of course, you can enter up in here, but we're at a premium. When we're too deeply in a premium, sometimes it's a little more risky to try to get in line, because you'll be chasing. Doing things like this, though, observing the fair value gaps, that's not chasing, especially if you have a good idea of where price is in fact headed to. So another thing I want to mention is, if you guys have gotten value so far with this video, you definitely want to check out some of my other videos and some of the playlists, like the Power 3 video, or if you need some motivation, I have ICT motivation videos, technicals wise. If you want to look for even further clarity, you definitely want to check out my previous videos that I produced the last couple months, because there's a lot of things that just layer on top of each other, right? Like I said, you want to have layered confluences. So yeah, if you guys got value, definitely like, comment, and subscribe, and I will see y'all on the next one.
Ict Fvg.